The information provided in this video is for educational and entertainment purposes only and does not constitute professional financial, investment, or legal advice. Credit cards involve financial risk, and individual results may vary based on credit history, spending habits, and financial management. Historical trends and potential outcomes discussed are not a reflection of every user's experience. Viewers are strongly encouraged to conduct their own due diligence, consult with a certified financial planner, and read all terms and conditions provided by financial institutions before applying for any credit product. Right now, thousands of Americans are walking through international airports with a ticking financial time bomb in their wallets, and most of them have no idea it is even there. You have seen the influencers on your feed sipping champagne in first-class pods or lounging in exclusive airport clubs, claiming they got there for free. They make it look like a magic trick. But here is the reality that the credit card issuers do not want you to hear. For a significant percentage of U.S. travelers, getting the wrong travel credit card is not a shortcut to luxury. It is a fast track to high-interest debt, tanked credit scores, and thousands of dollars in wasted annual fees. In fact, if you choose your card based on a flashy metal design or a sign-up bonus you cannot actually afford to hit, you are not the one winning the game. You are the one funding the free flights for everyone else. This video is not a surface-level list of card recommendations. This is a comprehensive masterclass designed to pull back the curtain on the complex machinery of the U.S. credit industry. We are going to break down the 5 critical pillars of travel credit that 90% of applicants ignore until it is too late. By the end of this deep dive, you will possess the exact framework used by professional point strategists to extract maximum value from every dollar spent, ensuring that your next international excursion is subsidized by the banks, rather than the other way around. To understand why this is so critical, we have to look at the current landscape of the American economy. We are living in an era where the cost of international airfare and lodging has reached historic highs. According to historical trends in the travel industry, the price of a standard economy ticket to Europe or Asia has outpaced inflation in several key sectors over the last 3 years. For the average American family, a dream vacation is becoming a massive financial burden. However, the U.S. credit card market is uniquely aggressive. Nowhere else in the world do banks offer the level of incentives, sign-up bonuses, and transferable points currencies that we see here in the United States. This creates a massive opportunity gap. On one side, you have the uninformed consumer who pays for everything with a debit card or a basic cashback card, effectively leaving a 2% to 10% discount on the table for every single purchase. On the other side, you have the strategic traveler who treats their credit cards like a specialized financial tool. The problem is that the barrier to entry for this level of travel hacking has never been higher. The terms and conditions for these cards are now hundreds of pages long, filled with complex jargon regarding variable APRs, minimum spend requirements, and point valuation volatility. If you walk into this without a plan, you are essentially entering a high-stakes poker game without knowing the rules. This masterclass is your rulebook. We are going to solve the problem of analysis paralysis. You will no longer have to wonder if you are getting the best deal, or if you are accidentally ruining your debt-to-income ratio. We are going to dive deep into the mechanics of credit scores, the hidden math of points versus miles, and the psychological traps that banks use to get you to overspend. Let us start with the first fundamental truth. The sign-up bonus is a trap if you do not understand your organic spend. When you see an offer for 80,000 or 100,000 points, your brain immediately translates that into a free trip to Hawaii or London. What you do not see is the requirement to spend $4,000, $6,000, or sometimes $15,000 within the first 3 to 6 months of opening the account. For a high earner in a city like New York or San Francisco, that might be a normal monthly budget. But for the average U.S. household, hitting that number often requires manufactured or forced spending. This is where the danger lies. If you spend even $1 more than you normally would just to get a bonus, you are devaluing those points. If you carry a balance and pay a single month of interest at the current average market rate of 20% to 28%, you have effectively wiped out the entire value of that free flight. We are going to analyze case studies of how different spending profiles interact with these bonuses. For example, consider a traveler who earns $60,000 a year. If they apply for a premium card with a $695 annual fee and a $6,000 minimum spend requirement, they are committing 10% of their gross annual income to a single financial product in a very short window. We will show you how to audit your last 6 months of bank statements to find your true organic spend. This is the only way to ensure that your travel card is a tool for profit, not a source of financial stress. Furthermore, we need to talk about the lounge delusion. Many U.S. travelers get a premium card specifically for airport lounge access. They see the marketing photos of quiet, serene spaces with gourmet food. However, in 2024 and 2025, we have seen a massive shift in lounge policy across the U.S. Crowding has become such a significant issue that many travelers find themselves waiting in 40-minute lines just to get a seat in a crowded room. If you are paying a high annual fee primarily for this perk, you need to know the specific entry requirements and guest policies that changed recently. We will break down which cards still offer true value in this department, and which ones are selling you a fantasy that no longer exists in reality. Then there is the issue of point devaluation. Unlike the US dollar, which is regulated by the Federal Reserve, the currency of your travel points is controlled entirely by private corporations, airlines, and hotels. They can, and frequently do, change the price of a flight in points overnight without any warning. This is known as a devaluation. If you are hoarding points like a savings account, you are losing money. We will teach you the earn and burn philosophy, a strategy used by top-tier travelers to ensure their points are used at peak value before the next corporate policy shift occurs. This masterclass is designed to move you from a passive consumer to an active strategist. We will cover the impact of hard inquiries on your credit report and how to timing your applications to avoid being flagged by internal bank algorithms, like the infamous 524 rule. We will look at the math behind transfer partners versus travel portals. Many people make the mistake of booking through a bank's website because it is easy, unaware that they could get 3 times the value by transferring those same points directly to a frequent flyer program. This is the difference between a $500 economy seat and a $5,000 business class suite for the exact same amount of effort. We are about to embark on a journey through the complex world of U.S. credit. By the time we finish all 5 points, you will have a personalized roadmap. You will know exactly which card fits your specific lifestyle, how to protect your credit score from unnecessary damage, and how to navigate the murky waters of annual fees and interest rates. This is about more than just travel. It is about financial literacy in a world designed to keep you in the dark. Let us begin with the first pillar of the Travel Credit Masterclass. The first pillar of this masterclass focuses on the primary bait used by every major financial institution in the United States: the sign-up bonus. In the credit card industry, this is known as the welcome offer, and in 2026, these offers have reached levels that would have seemed impossible just 5 years ago. We are seeing numbers like 150,000 or even 175,000 points flashed across digital billboards and social media ads. To the average traveler, that looks like a round-trip ticket to Tokyo in a business class suite. But to a bank, that bonus is a calculated customer acquisition cost designed to ensure you remain a profitable account for years to come. Imagine a traveler named Sarah. Sarah is a 29-year-old marketing manager living in Austin, Texas. She has a solid credit score of 740 and is planning a dream honeymoon to the Amalfi Coast. She sees an ad for a premium travel card offering a massive 125,000-point bonus. The catch? She has to spend $6,000 in the first 3 months. Sarah looks at her current monthly expenses. Rent is $2,200, groceries are $400, utilities are $200, and she spends about $300 on dining out. On the surface, it looks like she can hit that $2,000 a month target easily. However, Sarah encounters the first major hurdle of the U.S. credit system: the fine print on what actually counts as a purchase. Her biggest expense, rent, cannot be paid via credit card without a 2.9% processing fee from her landlord. If she pays her rent with the card to hit the bonus, she is immediately losing $63.80 every single month just for the privilege of using her own credit line. Over 3 months, that is nearly $200 in pure fees. Suddenly, her free trip has a $200 entry fee, plus the $795 annual fee of the card itself. Sarah is now $1,000 in the hole before she has even stepped foot on a plane. This is the reality of the sign-up bonus trap. If your organic spending, meaning the money you are going to spend anyway without changing your lifestyle, does not naturally meet the requirement, you are being manipulated into overspending. In Sarah's case, she might start buying clothes she does not need or upgrading electronics just to see that progress bar on her mobile app hit the finish line. This is a potential outcome that banks rely on. Historical trends in consumer behavior show that once a user increases their spending level to hit a bonus, They rarely scale it back down to previous levels once the bonus is earned. Beyond the math of the spend, there is an invisible gatekeeper you must understand before you even think about hitting the apply button. This is the infamous 524 rule, a policy that has become more rigid in 2026. This rule essentially states that if you have opened 5 or more personal credit cards from any issuer within the last 24 months, your application will likely be automatically declined by the system. It does not matter if you have a perfect credit score or $1 million in the bank. The algorithm sees you as a churner, someone who is only looking for a quick win, and treats you as a high-risk liability. Let us look at the step-by-step details of how to audit your status. To navigate the 2026 landscape, you must conduct a personal credit audit. This involves pulling your reports from the 3 major bureaus: Equifax, Experian, and TransUnion. You need to look specifically at the account opening dates. Many travelers forget about that retail card they opened at a clothing store for a 10% discount, or the specialized card they got for a one-time furniture purchase. These all count toward your total. In 2026, several banks have even started counting authorized user accounts toward this limit. If your parents added you to their card when you were in college to help you build credit, that could actually be the reason you get denied for your own travel card today. The strategy here is what professional points enthusiasts call velocity. You cannot simply apply for 3 cards in a single month. This sends a massive red flag to the automated underwriting systems. Even if you are under the 524 threshold, if you apply for 2 premium cards within 90 days, you might find your accounts being shut down for bust-out risk. The banks are using advanced artificial intelligence in 2026 to predict which users are about to go on a spending spree they cannot pay back. To stay safe, the general rule of thumb is to wait at least 90 days between applications, ensuring your credit report has time to stabilize and your debt-to-income ratio remains healthy. Furthermore, you have to account for the impact of the hard inquiry. Every time you apply for a card, your credit score takes a temporary hit of 5 to 10 points. If you are also planning to buy a home or a car in the next 12 months, these small hits can add up. A score that drops from 761 to 739 could be the difference between a 6% mortgage and a 6.5% mortgage. Over a 30-year loan on a $400,000 house, that tiny difference in interest will cost you tens of thousands of dollars. Is a sign-up bonus worth that? For most people, the answer is a resounding no. This is why the first thing you must do is a true financial inventory. You need to list every single recurring expense you have. Can you pay your car insurance in a 6-month lump sum? Can you prepay your gym membership? These are ways to hit a minimum spend requirement using money you were already going to spend, without paying the predatory fees associated with rent or mortgage payments. If the math does not work out, if you have to spend an extra $1,000 on things you do not need just to get $1,000 worth of points, then that specific card is not for you right now. There are mid-tier cards with lower spend requirements that offer a much better return on investment for the average American household. We also have to discuss the concept of the effective annual fee. In 2026, premium cards often carry fees ranging from $395 to $895. The marketing will tell you that the card pays for itself because it comes with $1,000 in credits. They will give you $10 a month for a specific rideshare app, $20 a month for a digital streaming service, and $200 for a specific hotel collection. This creates a psychological phenomenon called the sunk cost fallacy. You find yourself using services you do not actually like just because you feel like you have already paid for them. You end up ordering food delivery that costs $30 after fees and tips just to use a $10 credit. In reality, you just spent $20 you wouldn't have spent otherwise. The goal of this part of the masterclass is to make you realize that the sign-up bonus is not a prize. It is a contract. You are agreeing to provide the bank with a specific amount of swipe fee revenue and potential interest in exchange for a block of points. If you do not manage that contract with precision, you are the one being harvested. But what happens once you actually have those points? This leads us into an even more dangerous territory. Even if you hit the bonus perfectly, there is a silent thief that can take it all away before you ever book a flight. In the next part, we are going to dive into the volatile world of point valuations and the specific strategy you must use to ensure your hard-earned rewards do not vanish into thin air. If you think your points are safe just sitting in your account, you are making the single most expensive mistake in the travel world. We are going to look at why your points are actually a devaluing asset and how the major US airlines are planning to change the game in the second half of 2026. The second pillar of this masterclass is a concept that every professional points strategist lives by, but the average US traveler completely ignores: the reality of point devaluation. Imagine if the US dollar in your bank account lost 15% of its purchasing power every single year, but only when you tried to spend it at the grocery store. This is exactly how travel points and miles function in 2026. Unlike a traditional savings account where your money might grow through interest, your points balance is a devaluing asset. It is a private currency issued by a corporation that has a fiduciary responsibility to its shareholders to reduce its liabilities. Every point sitting in your account is a liability for the bank or the airline, and they are constantly looking for ways to pay off that debt as cheaply as possible. Let us look at a case study involving a traveler named Marcus, a 42-year-old software engineer from Seattle. Marcus is a saver. He has been using a premium travel card for 4 years, meticulously accumulating 400,000 points. He viewed this balance as his retirement fund for travel, a golden ticket that would eventually take his family of 4 to Tokyo in business class. In early 2024, that trip would have cost him roughly 80,000 points per person. But Marcus waited. He wanted to hit the $500,000 mark for peace of mind. By the time he went to book in 2026, the airline had transitioned to a fully dynamic pricing model driven by artificial intelligence. Because he was searching for a flight during a peak summer window, the price had jumped from 80,000 points to 180,000 points per person. In the span of 2 years, the real-world value of Marcus's points had been slashed by more than 50%. He did not lose any points, but the points lost their power. This is the silent thief of the travel world. In 2026, we are seeing major US carriers like United and Delta move even further away from fixed award charts. For instance, United's April 2026 program overhaul has effectively eliminated mileage earning for basic economy fares for anyone who does not hold a co-branded credit card. Simultaneously, they have introduced a 10% to 15% discount for cardholders on award flights. On the surface, this looks like a win for cardholders, but historical trends show that when an airline introduces a discount like this, they often increase the base price of the award seat by 20% a few months later. The discount is not a gift. It is a psychological anchor designed to make you feel like you are getting a deal, while the actual cost of travel continues to climb. To combat this, you must adopt the earn and burn philosophy. Points are like milk, not fine wine. They have an expiration date in terms of value. Your goal should never be to hold a balance larger than what you need for your next specific trip. If you do not have a flight or a hotel stay plan within the next 12 to 18 months, you should not be aggressively chasing points. Instead, you might be better off with a high-yield cashback strategy where your rewards can be invested in a liquid asset that actually appreciates. If you are going to play the points game in 2026, you must know how to calculate your cents per point or CPP. This is the only way to know if you are actually winning. The formula is simple but vital. Take the cash price of the flight or hotel room, subtract any taxes and fees you would still have to pay on a points booking, and divide that number by the total points required. For example, if a flight to London costs $1,200 in cash or 80,000 points plus $200 in taxes, your math is $1,000 divided by 80,000. That gives you a value of 1.25 cents per point. In the 2026 market, anything below 1.5 cents is generally considered a poor redemption. Why? Because many premium cards allow you to book travel through their own portals at a fixed rate of 1.5 cents per point. If your transfer to an airline gives you less than that, you are literally throwing money away. However, the real viral value, the kind that gets you into those first-class pods for next to nothing, is found in transfer partners. This is where the gap between the amateur and the professional becomes a canyon. When you book through a bank portal, you are essentially using your points as cash at a fixed rate. But when you transfer those points to a partner like Virgin Atlantic, Air Canada, or Hyatt, the math changes. We have seen case studies in 2026 where travelers have extracted upwards of 6 or 7 cents per point by finding sweet spot redemptions. This is how Marcus could have still made his Tokyo trip work. By transferring his points to a niche partner rather than booking directly through the bank's portal, he could have found a partner-operated flight that still used a fixed-price distance-based chart. But there is a catch that the credit card companies rarely mention in their commercials. Once you transfer those points from your bank to an airline, there is no going back. They are stuck there forever. If the airline suddenly decides to cancel the route you wanted, or if the seat availability disappears while the transfer is processing, which can sometimes take 48 hours, You are now holding a massive balance of miles in a single airline that you might not even fly regularly. This is why the third pillar of our masterclass is so crucial. You have to understand the technical architecture of these transfers before you ever click the button. Step by step, the process for a professional redemption in 2026 looks like this. First, you find the award space on the airline's website before you ever touch your credit card app. You must verify that the saver or partner level availability actually exists for the specific dates you need. Second, you call the airline or use a real-time chat tool to confirm that the seat is bookable. Third, only then do you initiate the transfer from your credit card. In 2026, several major U.S. banks have implemented instant transfer technology for most partners, but some still lag behind. You also need to be aware of the AI search trap. In the current year, airline search engines are more sophisticated than ever. They track your IP address, your device type, and your past searching behavior. If the system sees you searching for the same route 3 times in 1 hour, it may artificially hide the lower-priced award seats to create a sense of urgency, making you believe they are sold out. Professional travelers use incognito windows or VPNs to ensure they are seeing the true inventory. As we move deeper into this masterclass, we have to talk about the things that are even more valuable than the points themselves. Most people get a travel card for the miles, but they stay for the protections that they do not even know they have. We are talking about the hidden insurance policies that could save you $5,000 on a single trip if things go wrong. Most U.S. travelers are actually paying for double insurance, buying it through the airline or a third party, not realizing their credit card already provides superior coverage for free. But there is a very specific way you have to pay for your trip to trigger these benefits. If you miss one small detail in how you pay your taxes and fees, the insurance is void. We are going to break down the fine print fortress in the next part, including a secret benefit that can get you a personal concierge to handle your restaurant reservations and event tickets anywhere in the world, usually for zero extra cost. But first, we need to address the most misunderstood number in your entire financial life: your insurance trigger spend. Do you know the exact dollar amount you need to charge to your card to make sure you are covered if your flight is delayed by just 6 hours? Most people guess wrong, and it costs them hundreds in hotel vouchers they never get to claim. This specific threshold is often buried on page 40 of your cardholder agreement. And in 2026, the industry standard has shifted toward a more stringent definition of what constitutes a valid claim. To understand the gravity of this, imagine a traveler named David. David is a high-frequency flyer based in Chicago who recently booked a round-trip ticket to Tokyo for a major tech conference. Because David is savvy with his points, he used 160,000 miles for a business-class seat. To cover the remaining taxes and fees, which amounted to exactly $5.60, he used his premium travel credit card. He assumed that because the card was attached to the booking, he was fully protected. When a massive winter storm hit O'Hare International Airport, David's flight was delayed for 14 hours, eventually leading to a full cancellation and a rebooking for the following morning. David, thinking he was covered by his card's trip delay reimbursement, booked a $400 room at a nearby high-end hotel and spent another $100 on dinner and basic toiletries. However, when he filed his claim 3 weeks later, it was summarily denied. The reason? His specific card issuer required that the entire common carrier fare be charged to the card to trigger the insurance. Because he had used points for the base fare and only charged $5.60, the insurance algorithm flagged the transaction as a partial payment, rendering his $500 in expenses and out-of-pocket loss. This is the fine print fortress in action. In 2026, different issuers have vastly different triggers for their travel protections. Some cards only require a portion of the fare to be charged to the card, while others demand the full amount. If you are someone who frequently books award travel using points, you must know which category your card falls into. Historical trends in the U.S. credit market show that premium cards with higher annual fees are more likely to offer protection on award bookings. But even then, you must pay the taxes and fees with that specific card to establish the link. Beyond trip delays, we have to talk about the most misunderstood benefit in the American credit landscape: primary rental car collision damage waiver. This is where most U.S. travelers make a catastrophic financial error. When you stand at the rental counter in a place like Denver or Los Angeles, the agent will almost always try to sell you their daily insurance for $30 to $50. Most people decline it, thinking their personal auto insurance covers them. While that might be true, it is a risky path. If you have an accident and use your personal insurance, you are responsible for the deductible and, more importantly, your monthly premiums will likely skyrocket for the next 3 to 5 years. Consider a case study from early 2026 involving a traveler named Emily. Emily rented a luxury SUV for a weekend trip to Lake Tahoe using a standard travel card that offered secondary coverage. She declined the rental company's insurance. During a snowstorm, she slid into a guardrail, causing $8,000 in damage. Because her card provided secondary coverage, she had to file a claim with her personal insurance first. Her personal insurance paid the claim, but she was still out her $1,000 deductible, and 6 months later, her insurance company raised her annual premium by $400. If Emily had used a card with primary rental car insurance, the scenario would have been entirely different. Primary coverage means the credit card issuer's insurance company pays for the damage first, before your personal insurance even hears about it. In that scenario, Emily would have filed the claim directly with the card's benefit administrator. The $8,000 would have been covered, her personal deductible would have stayed in her pocket, and her insurance company would have had no record of the incident, keeping her premium stable. In 2026, there are only a handful of U.S. credit cards that offer true primary coverage. Knowing which one is in your wallet before you sign that rental agreement is the difference between a minor inconvenience and a multi-year financial burden. Furthermore, we need to examine the step-by-step reality of filing these claims in the current year. In 2026, most major issuers have moved to an automated, AI-driven claims portal. While this can speed up the process, it also means that your documentation must be flawless. If you are delayed, the first thing you must do is secure a statement of delay from the airline. This is a formal document that lists the flight number, the original departure time, the actual departure time, and most importantly, the reason for the delay. If the reason is listed as a mechanical issue or weather, you are usually covered. If the reason is listed as air traffic control or a generic operational issue, many insurance providers will attempt to deny the claim, citing that these are within the airline's control, and therefore the airline's responsibility to reimburse. You must also keep every single itemized receipt. In 2026, a credit card statement showing a $100 charge at a hotel is no longer enough. The claims adjuster needs to see the breakdown of the bill to ensure you didn't charge alcohol or entertainment, which are almost never covered under trip delay policies. You are essentially building a legal case for your own reimbursement. The burden of proof is 100% on the traveler. Another hidden layer of the fine print fortress is the definition of immediate family. If you are traveling with a partner you are not married to, or a friend, your card's insurance might only cover you. We have seen potential outcomes where a traveler was reimbursed for their own hotel stay during a delay, but their partner's expenses were denied because they did not meet the card's specific definition of an eligible traveler. In 2026, some cards have expanded this to include domestic partners, but you must have the documentation to prove it at the time of the claim. Then there is the issue of purchase protection and extended warranty. These are travel-adjacent benefits that can be massive in 2026. Imagine you are in London, and you drop your brand new $1,200 smartphone while trying to take a photo of Big Ben. If you bought that phone with the right travel card within the last 90 to 120 days, you are likely covered for the full repair or replacement cost. This is a benefit that applies globally, yet less than 15% of US cardholders ever utilize it. They simply assume the loss and buy a new device. As we move forward, it is clear that the value of a travel credit card is not just in the points you earn, but in the risks you offload to the bank. However, this only works if you understand the technical triggers. But even with the best insurance and the most points, there is one factor that can still make your travel experience miserable: the physical reality of the airport. As we look at the second half of 2026, the lounge landscape has changed forever. The days of walking into a quiet oasis just because you have a metal card are over. In the next part, we are going to dive into the lounge wars. We will look at the specific new access rules that went into effect this year, and why your favorite lounge might now require a $50,000 annual spend just to let you through the door. If you are getting a card for the luxury perks, you need to see the data on which lounges are actually still accessible and which ones are now essentially impossible to enter for the average traveler. We will also uncover the secret of the non-lounge airport credits that most people are leaving on the table. The current state of airport lounges in 2026 is no longer the hidden sanctuary it was a decade ago. It has become a battleground of capacity and tiered exclusivity. To understand this, we have to look at a traveler named Jason, a 34-year-old independent consultant from Denver. Jason recently upgraded to a flagship travel card with an $800 annual fee, specifically because the marketing promised him and his family a seamless luxury experience at every major U.S. hub. He envisioned himself walking past the chaotic crowds at the gate and settling into a plush velvet chair with a plate of chef-curated appetizers and a glass of premium sparkling water. However, Jason's first trip of the year to Hartsfield-Jackson Atlanta International Airport served as a harsh wake-up call to the reality of the lounge wars. When Jason arrived at the entrance of a renowned lounge, he was greeted not by a smiling concierge, but by a digital kiosk displaying a 55-minute waitlist. Because the lounge was at its fire code capacity, he was told he would receive a text message when a seat became available. By the time the text arrived, Jason's flight was already boarding. This is not an isolated incident. Historical trends from 2023 through 2025 showed a massive surge in premium card applications, resulting in a mathematical impossibility. There are now more cardholders with lounge access than there are physical square feet of lounge space in the U.S. airport system. To manage this, card issuers in 2026 have implemented what we call the spin-to-play walls. If you hold a premium card, you might think you have unlimited access for yourself and 2 guests. However, under the new 2026 policies, many major issuers now require a minimum annual spend of $75,000 on the card before they grant you complimentary guest privileges. If you spend less than that, you are now required to pay a $50 entry fee for every single guest you bring, including your spouse or your children. For a family of 4 like Jason's, a single visit to a lounge now costs an additional $150 on top of the $800 annual fee he already paid. This effectively changes the value proposition of the card entirely. If you are not a high spender or a solo business traveler, the math of the annual fee often fails to justify the actual experience you receive. But there is a secondary layer to this that most travelers miss, and it is hidden within the Priority Pass network. Priority Pass is a third-party service bundled with hundreds of U.S. credit cards. In 2026, the network has fragmented. Many of the most desirable lounges in airports like LAX or JFK have started restricting the hours they accept Priority Pass members. They might only allow entry between 10 a.m. and 2 p.m., which is exactly when the airports are at their quietest. During peak travel windows, early morning and late afternoon, these lounges display signs stating they are at capacity for Priority Pass members while they continue to usher in their own direct members. If your card relies solely on Priority Pass for its lounge perk, you are essentially holding a second-class ticket to a first-class facility. However, this is where the professional strategist finds the hidden value that others leave on the table. While everyone else is standing in line for a crowded lounge, the informed traveler is utilizing the non-lounge airport credits. In 2026, several mid-tier and premium cards still offer credits for airport experiences that go beyond a simple waiting room. For example, some Priority Pass memberships include a $28 credit per person at specific airport restaurants. Imagine if Jason had known this. Instead of waiting an hour for a crowded buffet, he could have taken his family to a sit-down bistro, ordered $112 worth of food and drinks, and seen the entire bill covered by his credit card benefit. Beyond restaurants, there is the Be Relaxed Spa benefit. In many major U.S. terminals, your travel card might grant you a complimentary 30-minute massage, an oxygen therapy session, or an aromatherapy treatment. These services are often overlooked because they are not listed in the flashy lounge section of the card's marketing. But in the high-stress environment of 2026 travel, a 30-minute professional back massage is arguably more valuable than a lukewarm chicken wing in a crowded lounge. Furthermore, we have the Minute Suites benefit. These are private, soundproof workstations equipped with a daybed and high-speed internet. Your card likely gives you 1 hour for free. If you are a remote worker or someone who just needs 60 minutes of absolute silence to take a call or nap, this is the ultimate secret perk. Jason could have booked a Minute Suite for his family, giving them a private room to relax in while he waited for his flight, completely bypassing the lounge waitlist. To truly master the lounge game in 2026, you must follow a 3-step pre-flight protocol. Step 1. Use a real-time lounge tracking app. Do not wait until you get to the terminal to see if there is a line. These apps now integrate with airport sensors to give you live occupancy data. Step 2. Check your card's specific guest policy for 2026. Many people are still operating on 2024 information and are shocked by the $50 guest fees at the desk. Step 3. Identify your Plan B options. If the primary lounge is full, know exactly where the nearest Priority Pass restaurant or Minute Suite is located. This ensures that you are always extracting value from that annual fee, regardless of how crowded the airport is. We must also discuss the technicality of authorized users in the context of lounge access. In previous years, you could add a family member as an authorized user for a small fee, and they would receive their own lounge membership. In 2026, the price of adding authorized users has skyrocketed. What used to be a $175 flat fee for up to 3 people has, in many cases, become a $195 fee per person. If you are adding people to your account just for the lounge access, you need to calculate the cost per visit. If your authorized user only travels twice a year, you are paying nearly $100 per lounge visit. You would be better off just paying the one-time guest fee at the door. The lounge wars are a symptom of a larger trend in the U.S. credit industry: the shift from static benefits to engagement-based rewards. The banks no longer want to give you perks just for holding the card. They want to reward you for using the card as your primary financial hub. This leads us directly into the most complex and potentially rewarding part of the travel credit card puzzle. While lounges are about where you wait, the next pillar is about where you stay and how you move. We are going to dive into the world of elite status and the invisible upgrade. There is a way to walk into a hotel in 2026 and get the presidential suite for the price of a standard room, or to get a car rental that is 3 classes higher than what you paid for, without ever saying a word to the agent. It all comes down to a concept called status matching and the hidden hotel portals. Most people book their hotels through a travel site and hope for the best. Professionals use a specific credit card architecture to force the system to recognize them as a VIP. But be warned, if you do this wrong, you can actually end up paying more for a discounted room than you would have for a regular one. We are going to look at why your elite status might actually be a liability in certain international markets, and how to use the 2026 Status Challenge to fast-track your way to the top of the loyalty ladder in under 30 days. But first, we need to address the hidden cost of the free hotel night. Is it really free if you have to pay a $50 resort fee and a $40 destination charge just to use it? We are about to break down the math that the hotels do not want you to see. The third pillar of this masterclass moves us from the airport terminal into the lobby of your destination, the hotel. In 2026, the concept of a free night certificate has become one of the most misunderstood assets in the U.S. credit card market. To the average traveler, a certificate for a free night at a luxury property sounds like a massive win that easily offsets a $95 or even a $650 annual fee. However, the reality of the hospitality industry in 2026 is defined by a practice known as junk fee layering. Even when the room rate itself is zeroed out by your credit card benefit, you are often still on the hook for a suite of daily charges that the hotel industry has rebranded as essential service fees. Imagine a traveler named Chloe, a 31-year-old freelance designer from Seattle. Chloe holds a mid-tier hotel credit card that grants her one free night certificate every year upon her account anniversary. She decides to use this certificate for a weekend getaway at a high-end resort in Miami. On the booking screen, the room price is listed as $450, but her certificate brings the total to zero. Chloe feels like she has successfully gamed the system. However, when she checks out on Sunday morning, she is presented with a bill for $198. The breakdown of Chloe's free night is a textbook example of the 2026 fee landscape. First, there was a $55 daily resort fee, which the hotel claimed covered high-speed internet, 2 bottles of water, and access to the fitness center, amenities Chloe already expected as a cardholder. Then there was a $35 destination charge, a relatively new fee in 2026 designed to cover local area activities that the hotel provides, such as a shuttle service she never used. Add in a $60 overnight valet parking fee and $48 in local occupancy taxes that are often calculated based on the original room value rather than the discounted price, and suddenly, Chloe's free night cost her nearly $200. Historical trends in the U.S. hotel market show that these non-negotiable fees have increased by 25% since 2024, specifically targeting properties where award redemptions are most common. To avoid this, you must understand the policy variations between the 3 major hotel giants: Marriott, Hilton, and Hyatt. In 2026, Hyatt remains the gold standard for points enthusiasts because they generally waive resort fees on all award stays for all members. This means Chloe's bill at a Hyatt property would have actually been zero. Hilton, conversely, waives resort fees on stays booked entirely with points, but their policy on credit card certificates can vary by property and region. Marriott generally does not waive these fees unless you have achieved top-tier ambassador status. This is a critical distinction. If you are choosing a travel card based on a free night perk, you are not just choosing a bank, you are choosing a fee structure. This brings us to the strategic use of elite status. In 2026, many U.S. travel cards offer what is known as automatic gold or platinum status. The marketing makes it sound like you will be greeted with a parade and an immediate suite upgrade. In reality, in a world where everyone has a travel credit card, gold status has become the new baseline. When everyone in the lobby is a gold member, no one is special. To get the invisible upgrade, the kind where you are moved from a standard queen room to a corner suite with a view, you have to leverage status matching. Step by step, a professional status match in 2026 works like this. You start with the status granted by your primary travel card. Instead of just staying at that one brand, you look for a status match challenge from a competing chain. In early 2026, several boutique hotel collections and international chains are aggressively trying to poach U.S. travelers from the Big Three. By providing proof of your existing status, these competitors will often grant you their highest tier for a 90-day trial period. If you time this match to coincide with a major multi-city trip, you can enjoy top-tier benefits like free breakfast for two, 4 p.m. late checkout, and guaranteed lounge access without ever having stayed a single night at that brand before. Consider the math of the free breakfast benefit alone. In a major metropolitan area like New York or London in 2026, a hotel breakfast for two can easily cost $80 to $100 after tax and tip. If you have a 5-night stay, that status benefit is worth $500 in real-world savings. This is how you move the needle on your annual fee. If you are paying $650 for a card but saving $500 on food in a single trip, the card has almost paid for itself before you even consider the points or the lounge access. However, there is a technicality in the 2026 terms of service that can strip these benefits away: the third-party booking trap. If you see a great deal on a popular travel aggregator site and book your hotel there to save $20, you have effectively voided every single benefit of your travel credit card. In 2026, hotels have become extremely strict. If the booking does not come directly through their own system or a specialized bank portal that is integrated with their loyalty program, you will not earn points, you will not receive stay credit toward higher status, and the front desk is under no obligation to honor your elite benefits. You might have platinum status, but to the hotel's computer system, you are just a guest from an OTA, and you will likely be given the least desirable room in the building. We also have to discuss the emergence of lifestyle credits. In 2026, travel cards are increasingly adding monthly or quarterly credits for things like boutique fitness classes, high-end department stores, or even specific sustainable clothing brands. These are what the industry calls breakage perks. The banks know that a large percentage of users will forget to activate or use these credits every month. If you are not a disciplined user of these niche services, you are essentially subsidizing the rewards for the people who are. We will show you how to automate these credits using digital calendar alerts and specialized browser extensions that remind you to spend your credit before it expires at the end of the month. As we look toward the fourth pillar of this deep dive, we have to address the engine that makes all of this possible: your credit score. But not the score you see on your banking app. In 2026, lenders are using a new generation of scoring models that look at your financial behavior in ways that would have seemed like science fiction a few years ago. They aren't just looking at if you pay your bills on time. They are looking at your spending velocity, your debt-to-limit ratios across specific categories, and even how often you ask for credit limit increases. If you want to keep opening the best travel cards and earning the biggest bonuses, you need to know how to manage your credit profile like a professional treasurer. There is a specific move called the credit limit reallocation that can save an application from a denial, but you have to know exactly what to say to the reconsideration line. In the next part, we are going to dive into the technical side of the U.S. credit system. We will look at why a 720 score might be better than an 800 score in certain situations and the specific reason why closing an old travel card could be the biggest financial mistake you make this year. We will also uncover the secret of the business credit card loophole, how regular U.S. travelers are earning double the points by opening accounts for side hustles they didn't even know they had. But first, we need to talk about the 2026 change to the hard inquiry system. Did you know that in some states, a single credit application can now stay on your record as a negative factor for longer than the standard 2 years? We are about to look at the data. In 2026, the the landscape of the American credit reporting system has shifted from a series of static snapshots to a continuous, trended stream of data. The introduction and widespread adoption of the FICO 10T model have changed the rules for every U.S. traveler. In previous years, a hard inquiry was a minor temporary dip, a small price to pay for a massive sign-up bonus. But today, the algorithm is looking at your trajectory over a 24-month window. Historical trends in lending show that banks are no longer just asking if you can pay your bills. They are asking how often you are seeking new credit relative to your spending habits. In certain states, legislative changes have allowed for more granular reporting, meaning a single inquiry on your Experian or TransUnion report can stay prominently featured in your risk profile for longer than the traditional 2 years if it is part of a pattern of credit-seeking behavior. Imagine a traveler named Alex, a 38-year-old project manager from Phoenix with a seemingly perfect credit score of 795. Alex decided to go all in on a trifecta of travel cards in a single month to maximize his points for an upcoming trip to the South Pacific. He applied for 3 premium cards in 30 days. On the first 2, he was instantly approved. On the third, he received a dreaded pending message, followed by a denial letter in his digital inbox 48 hours later. Alex was confused. His income was high, his debt was low, and his score was nearly perfect. The data tells a different story. Under the 2026 trended data models, the third bank's AI saw Alex's sudden burst of inquiries as a sign of financial instability or imminent credit expansion. To the machine, Alex looked like someone who was about to go on a spending spree they might not be able to cover. This is the 720 versus 800 paradox. A traveler with a 720 score who applies for 1 card every 12 months often has a higher approval probability than a traveler with an 800 score who applies for 3 cards in 90 days. The thickness of your credit file, the variety of accounts, and the length of your relationship with specific banks now outweighs the raw number of your score. However, Alex didn't have to accept that, no. This brings us to a step-by-step detail that most U.S. travelers miss: the credit limit reallocation. If you are denied a new card from a bank where you already hold an account, you have a secret weapon. When you call the reconsideration line, a direct human-to-human connection that still exists in 2026, you should not ask them to reconsider your creditworthiness. Instead, you should offer to move your existing credit. The script for this move is precise. You say to the agent, "I understand that the bank might not want to extend more total credit to me at this time. However, I have a $20,000 limit on my existing cashback card that I rarely use fully. Would the bank be willing to take $10,000 of that existing limit and move it to open this new travel card?" For the bank, this represents zero net risk. They aren't giving you more money. They are just letting you rearrange the money they already committed to you. In 2026, this one move has a high potential outcome of turning a flat denial into an immediate approval. Alex used this strategy, shifted $5,000 from an old college card he never used, and secured his third travel card without the bank needing to extend a single dollar of new credit. This leads us to the most powerful tool in the professional traveler's arsenal: the business credit card loophole. Many Americans believe you need a brick-and-mortar storefront or a staff of 10 to get a business credit card. In reality, in 2026, the definition of a business in the eyes of U.S. banks is broader than ever. If you sell items on an online marketplace, drive for a rideshare service, or even do occasional freelance consulting, you are a sole proprietor. Why does this matter for travel? Because of the 524 rule we discussed earlier. Historical trends show that most business cards from major issuers do not show up on your personal credit report. This means you can earn a 100,000-point sign-up bonus on a business card, and it will not count toward your 5-card limit. Imagine if Sarah, from our earlier example, had opened 2 business cards instead of 2 personal cards. She would still be at 0.24 in the eyes of the bank's personal card algorithm, leaving her wide open for the most exclusive personal offers. But there is a technicality you must respect. To apply as a sole proprietor, you use your social security number as your tax ID. You must be honest about your business revenue, even if it is only $1,000 or $2,000 a year. The banks are looking for intent to grow. In 2026, many banks have started requesting business verification more frequently, which could be as simple as a screenshot of your online seller profile or a basic business plan. If you cannot provide this, do not apply. But for those with legitimate side ventures, this is the fastest way to accumulate millions of points without damaging your personal credit profile. We also have to address the old card trap. Many travelers, frustrated by a rising annual fee, decide to simply close their oldest credit card. This is a mathematical disaster. Your credit score is heavily weighted by the average age of accounts. If you close a card you have had for 15 years, your average age could drop overnight from 10 years to 4 years. This makes you look like a young, and therefore risky borrower to the FICO 10T model. Instead of closing the card, you should perform a downgrade. In 2026, almost every premium travel card has a no-fee version within the same family. You call the bank and ask to product change your premium card to a no-fee version. You keep your account number, you keep your credit history, and your average age of account stays intact. Most importantly, you stop paying the annual fee. This is a potential outcome that preserves your credit power for future applications. As we master the technical side of the US credit system, we realize that the game is played on two fronts: the internal algorithms of the banks and the physical reality of using the card across the globe. You have the points, you have the score, and you have the insurance. But there is one final, invisible predator that waits for US travelers the moment they step off the plane in a foreign country. It is the currency conversion trap. In 2026, foreign transaction fees are just the tip of the iceberg. There is a new, more predatory system called dynamic currency conversion that is costing US travelers an average of 7% to 12% on every single meal and hotel stay abroad. Even the best travel cards in the world can't protect you if you make the wrong choice at a checkout terminal in Paris or Tokyo. In the next part, we are going to dive into the global ATM trap. We will look at why you should never, ever let a foreign terminal do the math for you, and the specific US bank account you need to pair with your travel credit card to ensure you never pay a single penny in ATM fees anywhere on Earth. If you think your no foreign transaction fee card is enough, you are about to see how much you are actually losing to the hidden exchange rate spread. The illusion of the no foreign transaction fee benefit is the first layer of this global financial onion. In 2026, nearly every travel credit card marketed to US consumers carries the no foreign transaction fee label. On the surface, this sounds like a total victory. It suggests that the bank is graciously absorbing the cost of converting your US dollars into euros, yen, or pesos. But this is where the transparency ends and the hidden exchange rate spread begins. When you swipe your card at a bistro in Paris, the transaction does not happen in a vacuum. It passes through a payment network, usually Visa or MasterCard, and each of these networks has its own proprietary algorithm for determining the daily exchange rate. While they generally stay close to the mid-market rate, there is often a microscopic spread that, when compounded over a multi-week international trip, adds a hidden cost of 0.5% to 1% on everything you buy. However, that is a minor concern compared to the primary predator, dynamic currency conversion, or DCC. This is a system that has become significantly more aggressive in 2026 terminals across Europe, Asia, and Latin America. Imagine a traveler named Liam, a 35-year-old architect from Seattle who is visiting Rome. Liam is at a high-end leather shop and picks out a jacket for 500 euros. When the merchant hands him the credit card terminal, the screen displays a choice. It asks, "Would you like to pay in euros 500 or US dollars $585? To Liam, the US dollar option looks safe and familiar. He knows exactly how much will be deducted from his bank account. He thinks he is avoiding the mystery of the exchange rate. This is exactly what the terminal wants him to think. By choosing the US dollar option, Liam is opting into dynamic currency conversion. In this scenario, the foreign merchant's bank, not Liam's US bank, is the one performing the currency conversion. This allows the local bank to set an arbitrary exchange rate that is often 5% to 10% worse than the actual market rate. In Liam's case, the real conversion at the mid-market rate should have been closer to $540. By clicking the button for US dollars, Liam just paid a $45 convenience fee. For a piece of math he could have done on his phone in 3 seconds. In 2026, these terminals have become even more deceptive. Historical trends in fintech show that many terminals now use dark patterns in their user interface. They might color the US dollar button green and the local currency button red, or they might hide the local currency option under a More Options menu. Some terminals even use confusing language like continue with conversion or continue without conversion. The rule for every US traveler is absolute. Always, without exception, choose the local currency of the country you are in. If you are in Italy, pay in euros. If you are in Japan, pay in yen. Let your US-issued travel card handle the math. Your bank will almost always give you a rate that is significantly closer to the true value of the currency than a random merchant terminal in a tourist district. But what happens when you need actual cash? Despite the world moving toward a cashless society in 2026, there are still many regions where paper money is the only way to pay for a street food tour, a local market purchase, or a small town taxi. This is where the global ATM trap catches even the most experienced travelers. Most people realize they should never use their travel credit card at an ATM because it triggers a cash advance fee, which usually carries an immediate 5% charge plus a predatory interest rate of 30% or higher that starts accruing the second the money leaves the machine. So the average traveler uses their standard US debit card instead. This is a massive mistake. When you use a typical US bank debit card abroad, you are usually hit with a triple threat of fees. First, your own bank will often charge you a $5 out-of-network fee. Second, the foreign ATM operator will charge you a convenience fee that can range from $3 to $12 per transaction. Third, you will likely be charged a 3% foreign exchange fee by your own bank for the privilege of using your own money. If you withdraw $100, you might end up paying $120 after all the fees are settled. To solve this, professional US travelers in 2026 pair their travel credit card with a specialized travel-ready checking account. There are a few specific institutions in the United States, such as Charles Schwab or Fidelity, that offer debit cards with a global ATM fee rebate policy. Step by step, here is how this works. You use their debit card at any ATM in the world. The ATM operator might charge you a $10 fee. At the end of the month, the bank looks at your statement, totals up every single ATM fee you paid globally, and deposits that exact amount back into your account. This is the only way to ensure you are getting the interbank exchange rate with zero overhead. However, even with the right debit card, the DCC trap still exists at the ATM. Just like the credit card terminal at the leather shop, the ATM in Rome will ask Liam, "Would you like this ATM to perform the conversion for you at a guaranteed rate?" The machine will use high-pressure language, warning that if he declines the conversion, the exchange rate cannot be guaranteed and may result in higher costs. This is a lie. If Liam accepts the ATM's conversion, he is again paying a 7% to 10% markup. If he declines the conversion, the ATM will still give him the euros, but the conversion will be handled by his US bank at the much fairer market rate. We also have to discuss the 2026 emergence of shadow exchanges. In many tourist-heavy cities, private currency exchange booths have started installing smart kiosks that look like official ATMs, but are actually private money-changing machines. These machines often have zero fees but hide their entire profit margin in a massive exchange rate spread. They might offer you 0.85 euros for every dollar when the real rate is 0.93. You might think you're winning because the fee column says $0, but you are losing nearly 10% of your purchasing power the moment the bills come out of the slot. As we move into 2026, the complexity of international spending has created a need for what we call real-time transaction auditing. Most major US travel cards now offer push notifications that tell you exactly how much was charged in USD the moment you swipe. If you swipe your card and the notification shows a number that seems significantly higher than the exchange rate you saw on Google that morning, you have likely been DCC'd without your consent. In some cases, merchants will select the US dollar option on your behalf without asking. If this happens, you have the right to demand they void the transaction and rerun it in the local currency. Understanding the global currency architecture is the difference between a trip that stays on budget and one that results in a $500 invisible tax by the time you return home. But currency is just the fuel for your travel. The vehicle itself is often the most expensive part, the flight. In the next part, we are going to look at the single most valuable perk in the travel world, and the one that is currently under the heaviest fire from US regulators, the companion pass. There is a way to bring a second person on every single flight you take for an entire year for just the cost of taxes and fees. It is the ultimate 2-for-1 hack. But in late 2026, the rules for qualifying for this pass are changing, and the credit card loophole that people have used for a decade is being closed by the major airlines. We are going to look at the data on how you can still secure this pass before the window shuts, and the specific triple dip strategy that can get you a companion pass and 2 international business class tickets with just 90 days of strategic spending. But be warned, the airlines are tracking this strategy more closely than ever, and if you miss one deadline by 24 hours, you lose the entire benefit. The 24-hour deadline is the primary reason why even the most meticulous travelers in the United States fail to secure the companion pass. To understand the gravity of this timing, we have to look at a traveler named Tyler, a 32-year-old high school teacher from Chicago. Tyler has spent the last 3 months of 2025 planning his 2026 travel strategy. He knows that the Southwest Companion Pass is widely considered the single most valuable perk in the domestic aviation industry. It allows a designated companion to fly with the pass holder for just the cost of taxes and fees, which is typically $5.60 for a one-way domestic flight. If Tyler earns this pass every time he flies from Midway to Orlando, Las Vegas, or even Hawaii, his partner flies essentially for free. In 2026, the requirement to earn this pass has settled at 135,000 qualifying points in a single calendar year. For a teacher like Tyler, earning 135,000 points through actual flying is almost impossible. He would have to spend tens of thousands of dollars on full fare tickets. Instead, Tyler uses the credit card loophole. He applies for a personal travel card offering a 75,000-point bonus and a business version of the same card offering an 80,000-point bonus. On paper, Tyler has 155,000 points, which is more than enough to trigger the pass. But this is where the 24-hour trap is set. The companion pass is valid for the remainder of the calendar year in which you earn it, plus the entire following calendar year. If Tyler triggers those bonuses in December of 2025, his pass is valid for the rest of 2025 and all of 2026. However, if he waits just a few days and ensures those bonuses hit his account in January of 2026, his pass is valid for all of 2026 and all of 2027. That is a difference of 12 full months of free travel. Tyler's mistake was not looking at his statement closing date. He completed his minimum spending requirement on December 28th. He thought he was safe, but his credit card statement closed on December 31st. The bank transmitted his 155,000 points to the airline on the final day of the year. Tyler earned the pass for 2025 and 2026, effectively wasting the entire 2025 portion of the benefit and losing out on an entire year of potential outcomes in 2027. This is the technical architecture you must master. In 2026, the banks and airlines have synchronized their data transfers to be nearly instantaneous. You must look at your statement closing date, not the date you make the purchase. If you want the maximum value, you should complete your spending requirement in the first week of January, ensuring that your statement closes and the points post in the new year. This strategy, known as the January Jumpstart, is the cornerstone of professional domestic travel in the US. But the Companion Pass is just one flavor of the companion benefit. In 2026, we have seen a massive shift in how other major US carriers like Delta, Alaska, and United handle their companion certificates. Unlike the Southwest version, which is unlimited, these certificates are typically one-time use. They are granted on the anniversary of your credit card. However, the data shows that 40% of these certificates go unused every year because travelers find the fare class restrictions too confusing. Imagine you have an Alaska Airlines companion fare. You think you can use it to fly from Seattle to New York for the holidays. You go to book, and the system tells you the certificate is not valid for the flight you want. Why? Because the airlines only release a specific number of seats in specific buckets for these certificates. In 2026, those buckets are smaller than ever. To use these successfully, you must use the expert mode on the airline's website to find flights with specific fare codes like L, V, or K. If you are just searching the main page, you are likely seeing fares that are ineligible for your free ticket. This leads us to the triple dip strategy, a high-level maneuver that few travelers outside the top 1% of points earners ever attempt. The triple dip involves using the massive influx of points you earn to get the companion pass to then book international travel for the primary traveler. Let's go back to Tyler. He now has 155,000 points sitting in his account. While he uses the companion pass for domestic trips with his partner, those 155,000 points are still his to spend. In 2026, he can transfer those points to international partners. He could potentially book 2 round-trip tickets to Costa Rica or Mexico using the points, while still using the companion pass to bring his partner for free on the domestic legs of the trip. He is effectively getting 3 vacations out of a single spending cycle. However, the 2026 landscape has introduced a new hurdle: the family language in credit card terms. Historical trends show that banks are getting tired of people like Tyler opening and closing cards every few years to chase these bonuses. Many US cards now have language stating that if you have ever held a specific card, or even a similar card in the same family, you are ineligible for the bonus for a period of 48 months or even for life. This means your 2026 strategy must be a long-term play. You cannot just burn through every card in 1 year. You have to map out which families of cards you are going to target and in what order. Step by step, the 2026 bonus audit looks like this. First, you create a spreadsheet of every credit card you have opened in the last 10 years. You need to find the exact date you received your last sign-up bonus for each card. Second, you cross-reference this with the anti-churning rules of each bank. Some banks have a 24-month rule, while others have moved to a 48-month or 60-month window. Third, you identify dead zones, where you are ineligible for any major bonuses, and use that time to focus on retention offers. A retention offer is a hidden benefit that 90% of US travelers never ask for. When your annual fee hits in 2026, do not just pay it, and do not just cancel the card. You must call the bank and speak to the retention department. In the current economic climate, the cost for a bank to acquire a new customer is upwards of $500. It is much cheaper for them to keep you. By simply saying, "I am considering closing this account because the annual fee is too high," you can often trigger a spend challenge or a flat point grant. We have seen case studies where travelers were given 50,000 points, the equivalent of $750 in travel, just for agreeing to keep the card open for another year. This effectively makes the annual fee a profitable transaction for the traveler. As we approach the final pillar of this masterclass, you now have the tools to earn points, protect your credit, navigate the airport, and maximize your international spend. But there is one final question that every traveler eventually faces. When is it time to walk away? The US credit market is a cycle, and the cards that are best for you in 2026 might be your biggest liabilities by 2028. Managing the exit strategy is what separates the masters from the people who end up with point fatigue and thousands of dollars in debt. In the final part of this series, we are going to pull everything together into a 365-day execution plan. We are going to look at the card portfolio sunset, the specific process for closing or downgrading cards without damaging your reputation with the banks. We will also reveal the 2026 blacklist, the specific behaviors that will get you banned from a bank's ecosystem forever, even if you have a perfect credit score. If you think you can just game the system indefinitely without consequences, you are about to see how the bank's AI is fighting back. We will close with the ultimate checklist. The 5 things you must do every single month to ensure your travel is never a burden, but a byproduct of your everyday life. The final piece of the puzzle is about sustainability, and it starts with the one thing most people forget to do the moment they get their first premium card. The one thing that almost every new cardholder overlooks the moment they receive that heavy, sleek metal card in the mail is the immediate establishment of a bulletproof repayment system. In 2026, with the average credit card APR in the United States hovering at historic highs, the margin for error has effectively vanished. If you carry a balance for even a single billing cycle, the interest charges will likely exceed the value of any points you earned during that period. This is the mathematics of the industry that banks rely on to maintain their massive profit margins. Imagine a traveler named Jordan, a 45-year-old healthcare administrator from Atlanta. Jordan followed every rule we have discussed so far. He secured a high-tier travel card, hit a 100,000-point sign-up bonus by timing his organic spending, and even used his credits for a lounge visit. However, Jordan failed to realize that his new card had a different statement closing date than his old ones. He missed a single payment by 4 days. Not only was he hit with a $40 late fee, but his interest rate immediately jumped to a penalty APR of 29.99%. Worse, because he missed the payment, the 100,000 points he earned were frozen until he paid the balance and a reinstatement fee. This is a common potential outcome in 2026. The bank uses the terms and conditions to claw back value the moment a user deviates from a perfect repayment history. Step 1 of your 365-day plan is the automation of your financial defense. You must set up autopay for the full statement balance immediately upon card activation. In 2026, many U.S. banks offer an additional incentive of 500 to 1,000 points just for enabling this feature within the first 30 days. But automation is not a substitute for auditing. You must still review your statement every month for 2 specific things: unauthorized zombie subscriptions and incorrectly coded transactions. If your local grocery store is suddenly coding as a general merchandise store, you are losing out on a potential 4% to 5% return on your spending. A professional traveler doesn't just spend, they verify. This leads us into the dark world of the 2026 blacklist. As the credit industry has become more automated, banks have deployed what are internally known as reward abuse teams. These AI-driven units are designed to identify gamers, travelers who follow the rules but push the limits of the bank's generosity. Historical trends show that certain behaviors will get your accounts shut down and your points confiscated with no path for appeal. The first of these is the purchase and return cycle. If you hit a sign-up bonus by purchasing a $4,000 item and then return it a month later, the bank system will flag you for fraud. Even if you spend that $4,000 elsewhere later, the initial hit on the bonus is considered a violation of the welcome offer terms. Another behavior on the 2026 blacklist is manufactured spending using gift cards. In the early days of travel hacking, users would buy thousands of dollars in prepaid gift cards to hit spend requirements and then use those cards to pay their bills. In 2026, this is a fast track to a permanent ban. Most major US issuers now have Level 3 data capabilities, meaning they can see exactly what you bought at the pharmacy or grocery store. If they see a $505.95 charge at a grocery store, a clear indicator of a $500 gift card plus a $5.95 fee, your account will be flagged for manual review. If you are caught doing this across multiple accounts, you risk being blacklisted from that entire financial institution for life. Managing the exit strategy is the final skill you must master. Every travel card in your portfolio must justify its existence every single year. We call this the value versus fee audit. Around the 11th month of your card membership, you must look at the data. Did the lounge visits, hotel credits, and points earned outweigh the annual fee? If the answer is no, you must execute the portfolio sunset we touched on earlier. Consider a case study of a traveler named Maya, a 30-year-old teacher from San Diego. Maya had 4 travel cards with combined annual fees of $1,200. After her audit, she realized she was only using the lounge access on one of the cards and hadn't used the hotel credit on another for 2 years. Instead of simply closing the cards, which would have damaged her credit age, she called each bank and requested a product change to a no-fee version of the card. This preserved her $45,000 total credit limit, which kept her credit utilization ratio low, while saving her $800 in recurring annual costs. This is how you maintain a sustainable, multi-decade travel strategy without draining your actual bank account. The 2026 365-day Masterclass checklist is your final roadmap. Month 1. Activate card, set up full balance autopay, and link to all high-spend categories. Month 3. Verify the sign-up bonus has posted and conduct a cents per point (CPP) audit to see which transfer partners offer the best value for your upcoming year. Month 6. Review your May 24th status and your trended credit data. If your score has grown, this is the window to ask for a credit limit increase to lower your utilization further. Month 11. The retention call. Contact the bank and see if they will offer a spend challenge to offset the upcoming annual fee. Month 12. The pivot. Either pay the fee, downgrade the card, or if you have a massive trip coming up, look for the next strategic application. Ultimately, the world of travel credit cards in the United States is not about finding a secret way to get something for nothing. It is about understanding that the banks have built a system designed to harvest the disorganized and reward the disciplined. If you treat your credit cards like a high-interest loan, you will lose. If you treat them like a specialized financial instrument, a tool that requires calibration, maintenance, and strategic deployment, you will find that the world becomes significantly more accessible. The historical data from 2024 and 2025 shows that the gap between the average traveler and the strategic traveler is widening. Those who don't know the rules are paying more than ever for flights and hotels, effectively subsidizing the luxury experiences of those who have mastered the pillars we have covered today. You now have the knowledge to be on the winning side of that equation. You know how to audit your spend, how to protect your score, how to navigate the airport, and how to outmaneuver the bank's own algorithms. But there is one final overarching truth that transcends all the math and all the points. The most valuable part of travel is not the first-class seat or the luxury lounge. It is the perspective you gain when you step outside your comfort zone. These cards are just the keys. Now that you have the keys, it is time to decide where you want to go. The 2026 travel season is already shaping up to be the most competitive in history, And while we have covered the 5 pillars of credit, there is an entire world of on-the-ground strategies that determine whether your trip is a success or a stressful disaster. In our next deep dive, we are going to look at the hidden global infrastructure, the specific apps, local SIM card strategies, and secret transit hacks that the world's most elite travelers use to navigate any city on Earth like a local, even if they don't speak a word of the language. If you think you're ready to fly, you're only halfway there. You need to know what happens when the wheels touch the tarmac.